Hey, what's up? This is Greg. Welcome to the channel. And on this channel, we talk about markets and investment. And on this video, we're going to talk about a subject that came on my radar screen in the past couple of weeks. And it's basically, why is Viacom so cheap? We're going to look into that question. We're going to look into all the details. And then at the end of this video, I'm going to come up with a recommendation on if we should go into this stock or not. In spirit of full disclosure, I already have an options position on the stock. So far, it has not worked out too well, but we're going to be looking at it step by step. And so if that's of interest to you, stick around because it's coming your way. Now, before we get into this, I want to ask you, if you do get value out of this video, please like and subscribe and hit the bell so you can get noticed when I come out with other videos, so you can be on board for all the future presentations. Okay, so with that, let's get right into it. Okay, so it was in the news in the last couple of weeks. 𝐥𝐤𝐤𝐞, which is technically a family office of Bill Hwang, who was a protege of Julian Robertson, who, if you don't know who he was the founder of the Tiger Funds. He's a legendary figure in the world of hedge funds. He was a dominant figure in the hedge fund business for over 30 years. He closed down the Tiger Funds in 2001, and Bill was a protege and an analyst of his. When the Tiger Funds closed down in 2001, Julian Robertson encouraged Bill to start his own fund, and in fact provided seed capital to help make that happen. I think it's safe to say that Bill Hwang had a generally very good track record in terms of investing. He was known for taking very large, concentrated positions, both long and short, and using a lot of leverage. Several years ago, he got out of the hedge fund business, being a multi-billionaire in the process, and he decided to set up his own family office to basically invest his own money, which at that point was, billions of dollars. Using the technique that he used successfully in the past, he took large positions in a number of stocks, and he used an enormous amount of leverage, tapping all the major financial institutions in New York and elsewhere. And what he did basically was he took enormous positions and he hid the fact, not illegally, legally, he hid the fact that he was taking these large positions by acquiring the positions within sort of shadow accounts that were in street name basically of the major lenders. Now, my understanding of it is he used swap arrangements with the banks to put tremendous amount of leverage on these positions, and one of the major positions that he had, of course, was Viacom CBS. As the story goes, his aggressive buying and enormous leverage that he used to continue to acquire Viacom drove the price up to enormous heights, around $100 a share. And as the story goes, in and around March 22nd, Viacom decided to do a major equity offering where they issued a total on a fully diluted basis of about 30 million shares, mostly of the Series B common stock, 20 million shares of that, and 10 million shares of a 5.75% coupon convertible preferred stock. Around the time that they did this, the stock started selling off, and in one day dropped close to 10%. Okay? Now, what happens when you have tons of leverage on a position is that if the stock declines enough, and if it starts to build momentum, the falling stock, you're going to get margin calls from your lenders, and that's exactly what happened. Now, I guess the smartest of the banks, being Morgan Stanley and Goldman Sachs and a couple others, I don't want to go into too much detail on this, but I just want to give you some background. They very smartly began to unload literally billions of dollars of his stock when the margin calls became evident, causing this horrible tumbling effect, and Goldman Sachs, Morgan Stanley, and a few other banks were able to get out of their positions early enough to avoid sustaining massive losses. Unfortunately for these two banks, Credit Suisse and Nomura were not so lucky, and they took enormous losses. So that's the basic windup of the situation and how we got to where we are today. Now, this was something that could have led to contagion. It didn't, luckily. It didn't crash the rest of the financial system. I guess it wasn't big enough. But basically what happened is Viacom stock went from $100 a share down to $50 a share, okay, almost overnight. I mean, within a few days. And then it traded from $50 a share down to $39 a share. It's since rebounded, but now it sits around $41 a share. So I was looking at this, when I was, I have a financial channel, so I was looking into it a little bit. And I started looking at the valuation of where Viacom is trading, and that's really what caught my interest. I think the best way to proceed here is, since we're probably all not media experts that are watching this, I know I'm not a media expert, I'm a financial person. Let's take a look at Viacom, and let's take a look at the sort of media conglomerate universe, because that's really what it is. It's a media conglomerate. And then I'm going to go in and look at a couple valuation metrics that will show you why I'm questioning, why is this firm trading at such low multiples relative to its peer group. Okay, so let's start looking at that right now. Okay, so as we often do on this channel, we switch to the on-screen mode here. And I just want to start by just going over like who is in this universe, and so who are we comparing ourselves to here with Viacom. This here is just the Wikipedia page here, but I was looking through and it shows a very good sort of summary of who the different players are in the media conglomerate business. In the mid-90s, the Telecommunications Act of 1996 was passed, which basically deregulated the media industry. That led to a lot of consolidation, and it created these huge media conglomerates. And you can see here, this is a nice chart that shows you, we have Comcast, which is a major player, the biggest, and this is ranked by size, right? So Comcast is huge. AT&T, of course, they went from being a long-distance provider into this conglomerate strategy, which is yet to prove out, actually. You have Walt Disney. Everybody knows who Walt Disney is. And you have Viacom. Okay, this is Access Discovery. Discovery was another one of the stocks that was massively sold off in this 𝐥𝐤𝐤𝐞 situation. But let's just focus on these four, right? These four, which I think are the most comparable in today's world. And the first thing that strikes me when I look at these is that, for all intents and purposes, they're all in the same business. They're all in the same businesses, right? They're in movie production, they're in TV production, they're in broadcast, they're in cable. They all jumped into cable, right? Because everybody thought that cable had stable cash flow and that was like 10 to 20 years ago. And now, with so many other media platforms vying for the same eyeballs, so to speak, cable is not viewed as so great anymore, because a lot of people are leaving cable and going to other, streaming services and other services that they can pay their money to, and in many cases, save money rather than having the cable. Look, they're in news, they're in sports, publishing. I guess Comcast is not in publishing, but the rest of them are. But you can see, you get the idea. They're all pretty much in the same business. So what that leads me to believe, starting out, the first thing is, if they're all in the same business, and some businesses are better than others. I understand that. If I were a media analyst, I'd have all these different opinions about who was better and whose streaming service was, kicking ass on the other streaming service and all this stuff. To me, it's important, but it's not important for the purposes of this analysis, because some might be better, some might be worse. But as I'm going to show you in a minute, Viacom is selling at an enormous discount to Comcast, okay? And it might not be as good a company. It might not be in businesses that are valued as high, but it's not as extreme as what I'm seeing. Okay, now let's jump over to my trading account and let's take a look at these 4 companies, okay? Now, I did a little pre-screening up front, and I found out that AT&T and Disney are currently showing a loss, so you can't really look at their PE ratio. So we're going to limit it. It's somewhat simplistic, but we're going to limit it to Viacom versus Comcast, okay? So first of all, here's Viacom, all right? Now, let's take a look at the chart so you can see the level of devastation that's occurred recently. Okay, look at this. I mean, this is just unbelievable, right? Let's go to 6 month. See, this was the buying that Huang did all the way up. Right in and around here is when they did their secondary offering of equity, in and around here. Then the cascading effect, the margin calls, the billions and billions and billions of dollars that this man lost, really unbelievable, got down to around 50-ish, 48, 50-ish. And, I guess I started looking at it like right in here, and I said to myself, this thing just sold off so much. At some point, it's going to form a base, and it's going to go back up. So I bought some options in here. But look what's happened since I bought the options. I mean, it's just gone down. So the options trade has not worked. But let's take a look at some of the fundamentals here. Or it's actually some of the multiples, just quickly. And this is the number that I want you to focus on. Look at this PE ratio. 10 times earnings. Okay, 10 times earnings. Okay, and keep this number in your mind. 605 million shares outstanding. Now that's after the stock offering, right? So, some people might say, well, the reason it's trading at a lower multiple is, they did this stock offering, 30 million shares, and there was all this dilution. Okay, I'm going to show you that that's not really the case. But before we do that, let's go over to Comcast. Let's compare this to Comcast. All right, Comcast. In the same business, might be a better company, might not be, might have a better future, might not be. It's certainly bigger. 4.6 billion shares outstanding. It has a much bigger market cap. But look at the multiple, 24 times, okay? So what this tells us is that Comcast is trading at more than twice the multiple of Viacom. Now, I mean, okay, you talk about dilution. Okay, we're going to analyze that in a second. You talk about better company and better, they're in the same businesses, okay? There could be, I could see Viacom trading at, I don't know, 18, 20, but 10? Something doesn't seem right here, okay? So with that said, let's take a look at this stock offering that they did. And we'll do some math on this thing, and we'll figure out how much the dilution should affect the multiple, okay? You can see here, we're talking about Viacom did a $3 billion offering. And in this $3 billion offering, they issued 20 million shares of Class B common stock at $85 a share, and 10 million of the 5.75 convertible preferred. Okay, so if we look at that on a fully diluted basis, which means we take all of the shares issued and we assume that the convertible preferred was converted, that on a fully diluted basis is 30 million shares. Okay, now if we take the we go back to Viacom, and we take 605 minus 30 million, which is what they started with. That's about 575, right? So 575 minus 605 is 30. If we divide that as to what percentage increase in outstanding shares that was, it's 5.2%. Okay? So 5.2% of dilution, which if there's more shares outstanding and equal earnings, the earnings per share is less, but that's not going to cause more than 100% decrease in the multiple. You follow me? And give me questions down below if there are some terms here that you don't understand and you want me to explain more. Okay, I'm trying to go through this in a time period that is relatively quick. So before I leave this screen, I just want to take a quick look at our technicals. And if you've been watching this channel, you know that I have some technical indicators that I use to determine whether something is oversold or undersold. And as you can see, we're very close to the 50-day moving average. This is the 50-day moving average. This is one standard deviation above. This is one standard deviation below. These are the slow stochastics, which is an oscillator index. You can see throughout this whole period, according to the slow stochastics, it was in a drastically oversold position. The relative strength index, oversold position. The momentum index, oversold. And anything below 40 is oversold in the money flow index. So money was flowing out of this thing the entire time. And what I couldn't understand is after the incredible sell-off down to 48, why did it keep selling off? And I think it's because other institutions continued to dump the stock. But as you can see, we are in a very oversold position. And so let's go back to the main screen and we'll talk about strategy. Okay, so as far as I'm concerned, I convinced myself that the reason it's selling at such a huge discount to the multiple of Comcast is not because they issued 30 million shares of stock. That only accounted for 5.2% increase in the amount of shares outstanding. That certainly wouldn't have done it. It's not because they're blatantly in other businesses that have historically and presently had lower multiples assigned to them, because they're basically in the same businesses. Now, is NBC materially worse than CBS? I mean, I don't think so. Are the news companies that they have any worse than Viacom's? Maybe yes, maybe no. I mean, if you were a media analyst, if you were a Wall Street media analyst, I bet you would have, the guy could write a book about the differences and why one is better than the other. But you can't convince me that Comcast is more than twice better than Viacom in terms of the multiple that it receives. I mean, that's very hard for me to believe. So what do we do with this information? Now, I have to confess, I'm not a big, lover of media stocks. I think a lot of these big companies like AT&T that, make forays into the media business usually end up wasting shareholder money. And to me, they're subject to changes in technology, witness streaming versus conventional networks and cable versus conventional networks. there's always something that comes along that will devalue their existing assets. So I'm going on record as saying I'm not a big fan of media companies in general. However, this appears to me to be an opportunity for someone who wants to go into something, maybe not bet the farm, but somebody who wants to go into something that probably has a very high probability of going up in the the intermediate to long term, and that's what I always try to emphasize on this channel. I'm not trying to encourage you to trade stocks. I'm looking for more long-term investments, and I think if you have certainly an intermediate to long-term horizon here, and you don't mind being in media stocks, this is a pretty good bet. Just a brief word on Disney. I think of the 4 companies that we talked about there, I think Disney is probably the best company. I think that they are second to none in terms of their intellectual capital and their creative capital and assets. I think they're second to none. I understand their streaming service is very successful, and that would be an alternative for a turnaround. I would also look at Disney. But in terms of this, in terms of a kind of a distressed asset play, so to speak, I would definitely recommend you looking into Viacom. Again, not bet the farm, but let's take a small position, and then what I will do is I will scale up if it starts to behave well. In other words, I would buy a small position, I would watch it, and then I would scale into my position based on how the stock performs. If it starts showing some strength, that means that some hedge funds and some institutions are starting to recognize this sort of arbitrage, so to speak, and are starting to recognize that relative to its peers, it's very undervalued. Hey, so I hope you enjoyed this video, and I hope you got something out of it. If you got something out of it, please like and subscribe and hit the bell so you can be on board for future presentations that will be coming your way very soon. And why wouldn't you do that? I mean, it's for free. All I ask for is a couple of likes and maybe a subscribe or two. I'm not charging you anything for this. I mean, you're getting free advice that you can make a lot of money on. And that's the purpose of this channel. So stay tuned so you can be on board with me for future presentations which will be coming your way very soon. I don't know. What do I know? I don't know. What do I know? You talking to me? You talking to me? Don't make me give you a Jersey beating, eh? Come on, subscribe. What, are you kidding me? Don't make me give you a Jersey beating, eh? Come on. Mafangu, huh? What are you doing over there? What are you doing over there, huh? Subscribe and like. And hit the bell. Don't make me give you a Jersey beat.